What's up, everyone? Welcome back to another weekly live stream with Stock Talk with David. I'm David. In this update, we're going through just a lot of financial news that's come out recently. It's been a while since we've done a live stream, so there's quite a few things to cover. First off, I'm just going to start with some CNBC headlines, go through maybe some of the outlook for the week, and we'll get into, obviously, the metamaterial stock. I know a lot of people watching this are really big into that one, and so we'll be sure to give that rundown, go through it, right? And just look at some of the other things happening, some of the other stories. So in the meantime, be sure to throw in some of your stock ideas into the chat and we'll give them a go, right? So first things up, we're gonna look through here and just see what CNBC is highlighting for us. Right now, the stock futures are up, which, I mean, after this much of a sell-off, you know, it's almost inevitable to see maybe stuff like this on a weekly basis, or at least on a beginning of the week basis, being that it's Sunday, right? S&P 500 obviously dipped into bear market territory, down at some point 20% off the highs, right? But it did actually make a pretty quick comeback. Very volatile, so really interesting what's going on there. We'll talk about that in just a little bit. The Dow traded up a little bit higher, so did the NASDAQ. S&P's about off 19% from its record high, which I think is maybe pretty close to where it is for the year, maybe down 17%. So somewhere in there, right? So 8 of the 11 sectors ended this week in the red, led by consumer staples. I think this is probably the most interesting one, the consumer staples, right? So think about it. When we have stuff like this happening, we have big sell-offs. Well, usually in the beginning of a sell-off or beginning of, fears of quantitative tightening, which just means that the Federal Reserve is going to be taking more money out of the economy. Where does the money hide? Well, the money goes to hide in the really safe stocks, and that's consumer staples, right? Now, what's interesting to me is that the money is leaving the consumer staples. It's leaving the safe stocks. And every single day that we've had a green day in the market, what's been the ones that have been leading the charge? It's been technology, right? It's been like Chinese tech, biotech, all of these things that are, obviously we're bullish on, but all these stocks too that everyone's kind of hating right now. Like they're hating these industries. So to me, it's telling me that there's some early movement going from the safety to the more, quote, risky stocks, the things that have been beaten up 60, 70, 80%, and the money's flowing back into them, right? And this happens after the first rate announcement. Consumer discretionary and communication finished the week more than about 32% off the highs. And again, investors are trying to come in grips with what's exactly happening and always trying to guess what the outcome is. Well, we know what the outcome is, right? We know there's going to be quantitative tightening. We know there's supply chain issues. So we know all those things. And now for us, it's just a matter of finding the right stocks to get into, which I think we'll talk more about that in just a minute. So let's see if there's any other updates from CNBC. Ukraine rules out ceasefire and ceding territory. I mean, no surprise there, right? I think this is something that's the war in Russia, or at least what's happening there, the war in Ukraine rather. I think that's something that's going to end probably sooner rather than later, right? So I would definitely take the under on that. When, I don't know, but I would say sometime soon. And this is what's interesting, right? Like if I pull up a chart here for the S&P, we'll use SPY, right? I think this will be pretty interesting. And we could go year to date. Okay. So you guys can see this, right? Just a lot of choppiness, right? We're off the highs, we're coming down. Okay. Well, what is this telling me? Well, I guarantee you that if we had an update that said the war in Russia, or the Russia-Ukraine war, it's over, it's done, this thing would pop up maybe 4.5%, 5%, 6%, maybe even 7%. This is a broad index, right? Why would it pop up that much when its normal positive day is maybe like 0.5% up, right? Why would it do that? Well, it's because we have these super emotional reactions to these exogenous events, meaning that when there's these outside events that don't necessarily directly influence the stock market, people get very emotional and they get very pessimistic very quickly. The fear and greed indicator, I think it's at about a 9 right now, which is pretty low, right? 0 to 100, 100 being the best, like 9 sucks, okay? But the moment you see this, you're going to see quick bounces up and everyone's going to start trading up again. They're going to start getting a bid. It's going to move back higher, right? So I think that's pretty interesting and updating. We'll go look at Trading Economics. This is probably one of my favorite websites to look at. A lot of smart money stuff here, guys. So CNBC is good for the first 2 minutes of your day, and then turn that trash off after because it's just not that good. Trading Economics, a little more smart, a little more numbers. So I always like this. They're saying this week we'll be looking for signs of the stock market. Costco, is this 522? Yeah. Macy's, Nordstrom, Best Buy. Federal Reserve will be publishing minutes, things like that. So we're still going to have some earnings. Looks like NVIDIA, Zoom, those guys. FOMC will be getting some quick updates on PMI surveys for Eurozone, United Kingdom, Germany, and France. So that'll be fun. And again, I would expect here, with the PMI numbers, I would say probably contracting for the next couple of months as it refers to manufacturing and industrials. I still think the short is there. I think the supply chain issues are there. I think, it's just not the business to be in right now at this moment. Maybe things more service-based where you're not as supply chain restricted, okay? So that's the week ahead. Any indicators we could look at here? Let's see. We can look at the interest rate. Go to the United States. So yeah, that rate is kicking up, right? This is the Fed funds rate. Remember, right in the middle of the pandemic, right? This is the beginning of the pandemic. We were at this 1.75 basis points maybe, or 175 basis points. And they come down here trading at 25 basis points. And now with the Fed hike, we're now at actually about 1. So that's interesting, meaning money's more expensive now. And really the average, is somewhere maybe right in here over the long term, right? Maybe somewhere in this 1.5, 2 range, okay? So they're just raising rates, trying to make things more expensive. So this is probably another reason why we're going to see the ISM down, and we're going to see industrial stocks have weakness, right? Now that's not saying they can't have these, monster 2.5%, 3% days every now and then, but it might just be a sideways grind, okay? So be patient with me. I'm also going to go into this right now. This is a guy, his name's Tom Hayes. He's a great hedge fund manager. He follows Warren Buffett pretty much to a T. One of my favorite people to listen to. I'm always learning from him. And I'm going to reference a couple of pieces in his weekly update. This is him right here on Fox News. But I'm going to reference a couple of things because I think it really ties into our investment strategy. And it ties into, we want to look at things, we want to look at industries that no one else is looking at, right? Because if you remember, we called in Q3 or Q4 of 2020, when we first started this thing, we called ExxonMobil perfectly, we called Wells Fargo perfectly. In Q1 of 21, we called fertilizer stocks. We were early on fertilizer, but now they're working, right? Later on in Q2, Q3 of 21, we called natural gas. Again, we were early, but now it's up a ton, okay? So being early isn't always a bad thing. I think it's just a matter of having the right execution and being patient, right? So he's saying that, a lot of the selling in the stock market, it's not natural. It feels more like a liquidation. He's talking about hedge funds liquidating here, and this is in regards to Melvin Capital, I think parts of Tiger Global. If you remember, Melvin Capital was one of the victims during the GameStop saga, short squeeze, epic, just interesting, really awesome ride there a little over a year ago, okay? So he's talking about rates. The 10-year skyrocketed from 1.37 in December, and it shot up to 3.19 earlier last week. And this is what he's saying. He's saying during this time, money's come out of crypto. How many of you guys in this have seen your crypto wallet, your crypto portfolio crash 40, 50, 60, maybe 90% if you're in some of the dumb coins? Innovation stocks, think Cathie Woods. Tech, think XLT. Biotech, China Tech, we're kind of in these guys now. We, as a group at Stock Talk, we really like this. And he's saying this is due to what? The higher cost per margin, right? Well, if I come over here and I look at the Fed's fund rate, what's happening? Well, the interest rate that's being charged at the very basic origination of money is starting to cost more. Okay, do you see that? So obviously, it's going to start costing me more money to borrow and to borrow on speculative assets. And as a result, margin calls are happening on these long duration, these non-cash flowing speculative assets, and concentrated fund redemptions. And this, again, goes back to the liquidations, right? As yields stabilize, and again, yields have definitely stabilized, talking about 10 years here, we're going to see a lot of stabilization in groups such as biotech, right? And we can talk about biotech. This is something that we've been kind of just whispering about, but I think we're ready to start really pounding it on. And big shout out to this guy because he put us on it about 4 or 5 months ago, right? XBI, this is an index fund, and they follow some of the smaller cap companies, okay? And he's saying that we saw this same pattern from 2015 to 2016 when the Federal Reserve tightened the funds. It fell 50% in anticipation of rate hikes from 2015 to 2016. What did we just say? We said that in anticipation of a rate hike, the money comes out of tech, it comes out of all those speculative assets, those non-cash flowing guys, and it goes into staples, and now it's pulling back out, right? So from 2016 to 2018, during this tightening, right? During the tightening, not before, but during the tightening, when they went from 25 basis points to 225 basis points, 225 basis points at a whole, same level, right? Same level, 25 basis points. Here we are around 1. XBI rose 140% off the lows. This year, or this time around, XBI is off about 60% in anticipation of these lows. Now that we have a couple of hikes under our belt, we might be finding a bottom in the near term. I think it's 4 out of 5 days, or maybe now 5 out of 6 days, that XBI, biotech, just in general, all the ETFs in biotech, and China tech, they have been going up on those days, right? Now, what is kind of stoking this, right? What is stoking this? Well, PFE, that's Pfizer, they bought this biotech company earlier this week for $11.6 billion, which may have ignited, he says, the animal spirits in the group as, quote, big pharma. They have a ton of cash, right? Because they're not making CapEx investments. Because, again, at this point in time, money is marginally more expensive, so they're not going to invest it in projects. What they're going to do is they're going to take this money and they're going to buy these smaller biotech companies, and they're going to use their technology to help extend the patents of the big pharma, right? Because think about it. Big pharma has to go out and renew the patent, do brand new research and development, spend tens of billions of dollars on all this stuff for the next 5 or 6 years, right? But they can go out and buy another company. They can go out and buy these smaller companies for cheap and get all their technology and just warp it into theirs, and now they have brand new stuff, and they did it for way less, right? Now, what he's saying is that this Pfizer, doing this deal earlier, this M&A activity, if they don't do it now, the other competitors will. Duh. Okay? So now it's just going to be a race to get in there, right? He's talking about a little bit of inflation. We can talk about that later if you guys want. I'm not super focused on inflation in this one. I will say, and I think I agree with him, that CPI probably peaked as the last week's reads were lower, and base effects, meaning as we compare these inflation reads year over year, they're going to get a little bit smaller, right? That year over year growth, or might even go even negative, who knows, okay? What that means is now the expectation starts to go down, and if the expectation is down, everyone chills out about inflation. Finally, they're not acting all crazy and stupid and raising their prices in anticipation of inflation. They're just staying put, or maybe you might see some discounts coming in the second half of the year, right? I'm not a genius, but after a while, if you understand financial history, right? Like, I'm pretty young, Okay. But I understand enough of financial history to know that this stuff seems to be a cycle, right? And I'm not going to make the same mistakes that other people made. I'm just going to learn from theirs and do my very best, right? And that's a lot easier said than done. It takes a lot of emotional fortitude. And sometimes we make mistakes, right? I'm not afraid to say that, but we're going to learn the best we can from other people, okay? He calls this section clearing the toilet. If you remember, if we look at the stock market for the past, we can look at it for the past few days. I mean, this looks unnatural, right? You're like, what happened right here? What has happened from here to there to cause all of this? Well, really, what has changed in the economy? Nothing. I mean, we haven't gotten any big update from here to here, okay? But what it is, and he's saying it's this, is that it's actually Melvin Capital liquidated $7.8 billion of their fund, right? And maybe even more if you include leverage. So the thing about liquidation is that you don't tell anyone you're doing it till after, otherwise the rest of Wall Street's going to screw you over, okay? I'm going to pull up here some of the things that he was selling. Advanced Auto Parts, Align Technology Tech, Amazon, that's tech, right? AutoZone, Bath and Body Works. Let's see, CoStar, Deere, Dollar Tree, Domino's, Expedia, Gartner, it's like a big research company, Live Nation, Marriott, MGM, Microsoft, right? S&P Global, Spotify, Snowflake, Uber, Visa, etc., right? What do these pretty much all have in common? Right? Like, what do you think these have in common? Well, they're leaders in their field, in their respective field, okay? So if they're leaders in their field and there's heavy selling in there, that's a very quick way for the rest of the market to see the selling happening in these big guys and say, oh my gosh, Amazon just take 10, 20, 30% this year. Let's sell the rest of the market. So the rest of the market's going to depend on these guys. But do you really think that if I pull up Amazon's chart, this may not be the best example for what I'm about to say, but I think if you have a decent IQ, you'll get the point, right? But do you really think that if this war in Ukraine, right? If the war in Ukraine is happening, but do you think that this little spot of the world, and I'm not downgrading, I'm not degrading them at all, but what I'm saying is that little spot in the world, do you think that's going to have this 40-50% effect on Amazon, right? Like, do you think that you're going to buy less packages because there's a war in Ukraine? Or Facebook, for instance, that your Aunt Joe is going to post less photos and like less stuff and buy less things on Facebook Marketplace because there's a war happening in Ukraine? Absolutely not. You would be foolish to think so, right? So I think what's happening is we're getting just, again, those overreactions to exogenous events, okay? And we're just seeing big time guys selling a lot of shares in these companies. Like he sold 436 billion worth, 133 shares, 133,000 shares of Amazon, right? That's a ton, right? Bath and Body Works, almost 4 million shares worth. So they're definitely dumping, right? And that's going to cause a lot of capitulation, a lot of surrendering rather in the market, okay? It is a great article. I mean, I could just read this all week long and find some good stuff in it. Let's see. Okay, and he's talking about Warren Buffett, which I think if you've been on this channel for any amount of time, like, you know that we have a very specific way of doing things, right? Like, I'm not looking at day trading. I'm not looking at, the 5-second high of a stock or the 5-minute high, right? I don't really care about that stuff. Technical analysis, it has its place, but probably it has its place in maybe, the last 10, 20% of your process, nothing more, right? That's why I like this guy. That's why I also like what we do, is that we really look at a lot of value things. We take a lot of look at the financials. But anyway, moving on. What Warren does, and watch what he does, not what he says. Warren Buffett put about a third of his cash hoard, about $50 billion, to work since the beginning of the year. Everyone else is puking, they're crying to their mamas, right? But what was Warren Buffett, I would argue, probably one of the greatest of all time. What was he doing? He was shopping, right? He was shopping for these great deals. Wall Street is the only place that when they have a sale, literally nobody shows up. I don't understand it. We today in town, the brand new Marshalls just opened up, and there's a line out the door, right? But nobody has a line out the door when their stock's on sale on Wall Street. I just don't get it, right? On Tuesday, he's saying that they talked about this, blah, blah. But now he's saying not the time to go all in just yet, but definitely the time to start buying high-quality companies and sectors trading at deep discounts due to rates and tightening fears. Literally, the biotech, the China tech, it's so out of favor, right? But now it's starting to come back in favor. If you guys remember about maybe 4 weeks ago, 6 weeks ago, JP Morgan, I believe, comes out with a note saying that China tech is uninvestable. You can't invest in it. It's so bad. But then what did they just have earlier this week? They just had a price target raise, and they took it all the way from underweight, I think, to overweight, which is a two-step upgrade in that tier system, right? That's huge. So they backtracked it. They said, oh, we had an error. Sorry. We didn't mean to put this note out. 6 weeks later, whatever, that's a BS. And now looks like they're starting to buy back into BABA. So just a matter of time. And that's Chinese tech. Okay. This is sentiment. This is Bank of America Global Fund Manager Survey. This is just talking about what the fund managers are doing right now. Like, think of hedge fund, pension fund, all those guys. The smart guys. They have the highest cash balance since 9/11 since 9/11, right, in 2001. They're the most underweight stock since May 2020. Now just think big picture. What do we know about 2020 as a trading year, right? It started off really sucky in the first quarter because of COVID, right? Kind of stabilizes, and then out of nowhere it just shoots up, but they were underweight stocks. Well, I would argue that where we're at right now in our stock market, obviously it's down. We're off 18, 19, 20%, right, from highs this year. But what does that mean for us? Well, we don't want to be underweight stocks. We want to be in the stocks because now we have the flexibility, we have the mobility to just throw them in, right? And I'm definitely, I think, starting to repeat myself, but I really want you guys to understand this, okay? So they're saying too crowded. The biggest tech short since August 2006, and that rallied 42% next 1.5 years. So you're saying right now everyone's super short tech, they're super short bonds, right? What are they most in? They're most long oil and commodities, and they're short the 10-year yield. Again, short bonds. So earnings and multiples, I think right now we're trading at about 17.5 times 2022 EPS and 16 times 2023 EPS. Could they go lower? Yeah. But what's going to, a broad base like that, right, the price to earnings multiple for the S&P 500, what's really driving that is it's all of the forward earnings essentially of the S&P, and that measures the strength of the companies, right? What event would have to happen that's not a black swan event? So don't think about monkeypox or COVID or any of that stuff, but what would have to happen that we can think of that would be practical, that's kind of inside the box? Well, that would be rates moving up a lot higher, okay? The big difference is that rates at 2000 were at 6.82% versus today, right, where they're at maybe 290 basis points versus 682 basis points, right? I mean, do you guys get what I'm saying there? So what this means is that what's going to drive the S&P lower itself would be a big spike in rates, and I just don't see that happening in regards to the 10-year. The federal funds rate, yeah, sure, absolutely. Not so much in the 10-year itself, right? Will the 10-year move? Sure. But it's kind of calming down, right? So I don't think it's going to be shooting up like crazy. If it does, that's a lot of chaos in the market. We know volatility in one asset class quickly translates to volatility in the others. He's saying, same thing here. Anticipation and fear of the tightening cycle, China tech and biotech. Alibaba sold off 53% during this time. XBI sold off 52% of the time. After this, biotech and BABA, sub that out for China Tech, or KWEB is a great ETF, right? Again, this is not financial advice. Please talk to your own financial advisors. Just opinion, not advice. I only deal with my own portfolio, and I'm just here for educational purposes, right? My lawyers told me to say that. So moving on. After this 2016, the Fed raised 8 more times over the next 2 years. Great. Biotech moved up 140%, and Alibaba was up 258, right? After 8 rate hikes. Guys, come on. Like, that is supreme, okay? The fear of tightening can be much worse. And again, that's what, that's what's been driving this down since, you can even say March or February, like right this time. That's what's been driving down Amazon, right? And I would use Amazon. I would put any stock in right now, and I would say that's basically been the theme, okay? So, he's saying they've been early. We've been early on a lot of stuff too, but it's always turned out to some great wins, okay? We just talked about sentiment. This is the biggest tech short, August 06. We are definitely percent overweight tech. Like, this is what they're saying here. This is how much they're short, right? That's just what you got to look at. Last time the managers were short tech was here and here, and that's to just look. Short tech here, look where you ended. Wow, okay. And this is a great chart. This is really awesome. This is showing where everyone is, where these fund managers are. Mostly short tech, and they're short bonds, right? They're short consumer discretionary. I think this one might be a little more iffy, right? But definitely short bonds, okay? And they're super long cash, so they're not invested. I wouldn't look at it like, oh my gosh, like they're in a ton of cash. This could be a definite catalyst. This could be gasoline on your 4th of July fireworks, guys. Like, this is awesome, because if they have this much cash to throw in, well, they have to buy back all of their shorts. They're going to pump those up. And you'll probably see these come into favor, and what they're doing here come out of favor, right? Anything else here to look at? Fear and greed, like I said, it's at a 9. This is great. Yeah, so that's pretty much it. That's what I have there on like overall stock sentiment. We can talk more about biotech and Alibaba soon. Be sure, if you guys are new, welcome in. Be sure to subscribe to the channel. Love to have you. And throw in some questions for the chat. I'd love to answer. We're going to look at some stocks for you guys. But now we're going to look, after all that, we're going to look at metamaterials, kind of definitely switching gears here. If you've watched some of my videos, you'll know that I'm not the biggest fan of Meta, but this is how we got our start, right? Back in 2021, early, we invested in this company called Torchlight. So big shout out to my friend Graham that found it. And we found that at like 30, 40, 50 cents and rode it all the way through. And if you know the story now, it's morphed into this company called Meta. So that's pretty cool. So I'm going to look at a couple of things. We're going to look at the... just do a quick overview, and then we can dig a little bit into the new updates that have come out for them. So give me just a second. We're going to pull it up here. Okay, this is cool. So this is saying total revenue. I'm kind of more focused on this right here, this 2021 and what we got here. So 263% growth, 405% growth. That's great for a very small cap company. I mean, they're a $500 million market cap. That's awesome, right? That's a lot of growth. You would expect to see it in something this small. Okay. Gross profit, 83%, 77%. I would expect as they start to hit I wouldn't say economies of scale, but as they ramp up production, probably the next 5 or 6 years, I would suggest that I would suspect rather that gross profit kind of falls and becomes maybe more in line with like 50%, 45%. That seems kind of the average for stuff in tech. again, just my own analysis, right? My own experience. So we got a share price of $1.85, right? So it definitely falls in that penny criteria. 296 million shares outstanding. And then as far as the historical capitalization, so we're actually looking at, what makes up this market cap, right? What's actually making up the structure of this company. Well, they've got $29 million in cash and debt of $80 million, right? Total enterprise value. So total enterprise value, that's just an adjustment for cash, but then you throw in some of the debt, the pref ec, the minority interest, and you throw out some of the marketable stuff. So about 600 million in market cap, right? And we can look at some of their capital. Book value of the common equity is at 321, right? So they're trading a little bit above book, and then total debt again at 80. Okay. Total enterprise value to total revenue, 142 to 92. So this really means that they're actually not making a ton of money, right? They're making $6 million. That's not a lot for a market cap this size. So they're trading very richly in price to sales. Okay, so for me, I'm not the biggest fan of that, but I know the story enough to know where the company could be moving. Okay, so stay with me here. If you've never looked at a company like this, or looked at a company using this format, looking at the financials, looking at estimates, stay with me because I think you'll learn something, and I have a lot of fun doing this. Okay. So EPS is a measure of how much they're actually making on a per share basis. It helps us conceptualize, how much the company is actually making. And excuse my sniffles, it's definitely pollen season in Florida, so thank you for your patience. So yeah, we look here at EPS, we can see losing 18 cents a share. I don't love to see it, but I look at 39 and I look at what they're doing here at 18. That's good for me. Okay. Revenue, that's an increase. This is obviously estimates, but I would say these are pretty close typically. EBITDA slightly worsening. EBIT slightly worsening. Net income much better. Okay, so they took this loss and they cut the loss in roughly half, right? Again, these are estimates, but I would say we're getting pretty close with it. Free cash flow, a little bit better. Not a ton of great stuff there. Okay. See what we've got on ratios. Again, because some of this stuff with the company, it's a more fresh company than others, and also the fact that it's kind of hard to comp it in general, right? It's kind of hard to comp the company, or compare it rather. So you're gonna get a lot of these not meaningful, these NMs. It's whatever, but we'll just look at it anyway. Gross margin. Obviously that's coming down. SG&A, that's really, really high. So to me, what this is they're almost in this pre-built out revenue stage, but they have a lot of catalysts coming up. Okay, so we can talk more about the catalyst in a second. Anything in here do we think will be great to look at? Debt to equity, 25%. Debt to capital, 20%. So these are solid numbers, right? I'm not crying about it yet. Altman Z-score 5.62. Anything below 3 is good. Anything over 10 is a little scary. 5.6, that's okay to me. Okay, so now we're going to look at balance sheet. I'm not going to compute a lot of ratios. I'm just going to call out some qualitative things that I see, right, for the sake of time. And these are in mostly US dollars. Okay, so that's good. Look here. Okay, so what do we have on cash? Well, we have $29 million in cash. That's good to me. I like that idea. And then I'm looking down here at liabilities. Maybe look at the debt. Okay, so I'm seeing that cash is decreasing, and liabilities are only moving up slightly, which would maybe mean to me that they, are they growing? What are they doing? Where is that cash going? It's something we have to figure out, right? Long-term leases. This refers more to like building leases and maybe even some machinery or equipment stuff. I don't really care about that. That's just an accounting rule. They have to throw that in there. Short-term borrowings. This is pretty high, guys. Okay, this is the short-term borrowings are higher than the long-term debt. So we really want to see them picking up the pace, right? Making the revenues. And I almost think that they have more short-term borrowings than they do revenue. That's not a great sign, but again, knowing the company itself, something that I'm not sure. Maybe you guys who have a lot of experience in accounting, I know a lot of my friends inside of our channel and our group, they know about this stuff pretty well. But goodwill is a measure of, think about, if you acquire a company, if I go to buy all of Tesla stock, right? Is it worth the hundreds of billions or maybe the trillions that it's worth? Like, do they just have that setting in the bank and in revenues and in assets and all that stuff? Absolutely not. So how do they get some of this worth on their balance sheet? How do they show this worth to investors and to creditors and those guys? Well, they have a metric, and it's called goodwill, right? And goodwill basically just measures what is, for instance, the technical definition is, the premium purchase price paid over the book. Another way to put it is saying, what is your customer base? What is your workforce? What is your purchased intangible assets? So maybe some of those patents that you buy from the smaller biotech companies, right? Intellectual property, franchises, things like that. So that's in here too. This is a lot of goodwill. That is a lot of goodwill. And Eric's saying price paid over book, and yeah, you're 100% right. So what I'm looking at here though is how high is the goodwill compared to the company itself? Well, goodwill is making up over half of the total assets. I'm not a big fan about that, right? To me, this goodwill number is probably highly related to the Torchlight business, right? So that's not my biggest thing. Eric's in the chat, but he's a super smart CPA, so shout out Eric. But we can look more and let's get an answer for you guys of, how is this goodwill, how is that going to affect the spin out of the preferred shares and the Oilco spinoff itself? So that's a good point to bring up. Let's see, inventory. We're seeing sales growth and inventory growth at the same time. I think sales growth is definitely going higher than inventory, which is good. Prepaid expenses, again, these are all pretty common with businesses that are ramping up operations very quick. Let's see, anything else? The equity section is going to be interesting to see. So total liabilities, 92 million. Long-term debt, what are the big things here? It's just really short-term borrowings. Don't have anything in convertible shares, which is great. Common stock, additional paid-in capital, right? So you're going to see the additional paid-in capital that's basically just, contributions from the shareholders itself in excess of par, right? That's the nerdy definition. Just means, essentially almost like what are the proceeds. So we're finding that, right? We're finding this common stocks, right? This paid-in capital, the retained earnings. I want to see, this is basically how much of the net income, are they keeping year over year over year over year, right? You just want to see retained earnings just growing, but these are actually getting worse, right? Again, almost characteristic with a growing tech company, right? But there are some exogenous events that we have to look at. We can't just look at this balance sheet and we can't look at the financials and just write off the company itself, okay? So let's see what else we have here. Anything else? I don't see change in working capital. It's okay, it'd probably be a crazy number anyway, given how far these are moving off. Cool, so let's look at this. My favorite website to use for short data is shortsqueeze.com. And I hope I spelled it right. Perfect, cool. And then MMAT. Now, as we all know, this thing has been getting shorted like crazy recently. Apparently, it's on one of the top lists of all stocks to be shorted. It's trending on Wall Street Bets. Um, and this is interesting, right? So disregard all of the long-term financial stuff for a second, and let's look at this, right? 1.5 days to cover on the ratio on the short interest ratio. Um, what this essentially means is you take all of the shares sold short and you factor it into how the daily volume, and it tells you how many days would it take for the shorts to cover their shares. The higher the number, the more I would say the more potential it has to short squeeze. Anything over 15, you probably want to stay away from if you were looking at shorting it. But if you're going long and it's got a short days to cover ratio of 15, maybe it's a short squeeze if you understand the company, right? Now on this, I'm going to attempt to build a chart that shows us stock price and short interest. So give me a second. I think it should work. Let's see. Eric, if you're still here, do you have any stock ideas? Anything you want to look at, man? Cool. All right, so now look at this, right? This is pretty insane, the amount of short interest thrown into the stock, right? This is the huge highlight on Meta. Check this out. The stock price itself, is in blue right here, okay? As this thing has been trending lower, it's been getting shorter and shorter, or more shorted, more shorted, more shorted, more shorted, more shorted, right? This is a huge, 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 huge catalyst right now to bring Meta, I would say, to short squeeze, right? I'm not a fan of the financials, but being the super smart guy that I am, just kidding, but understanding finance enough and knowing what happened with AMC when we called that, when Eric actually called out GameStop about a month before it popped. Look at this though, just every single reporting period, short just goes up, 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 and Meta's just consolidating, just staying here, right? So it's just going to take a catalyst or two. This share price has been rallying though, right? We went from 117. We're trading at 1.85, I think was the close. So that's great. Okay. I think we get over 2. That's a good round number. It's a very qualitatively pleasing number, if you know what I mean. So you get over that, I think we'll start seeing some interesting things. And what did we have over here from our really smart hedge fund guy? What is it? The higher cost for margin, right? The cost to borrow is going through the roof. This is confirmed by the Fed's fund rate, which they basically said the very beginning of all money borrowing, and for lack of better terms, the money market, although it's not quite what it is, but when we first go to a bank to get a loan, it almost originates here from the federal funds rate. And look at this, just shooting up quickly, go from 25 basis points, now we're at 100 basis points. And look at that. So I think we have a lot of room to go with Meta. I'm going to pull off the short interest chart. Again, that short interest chart itself is up like 400 something percent. That is insane. Okay, 400% increase on Meta. That's crazy. Be sure to call that one out later. I'll post that on Twitter and we'll talk about that. Yeah, but yeah, look at this, 1.85. We're sitting here at highs of 8. This is all short squeeze, fallout. But yeah, I mean, look at that. I mean, just even to get to from $2 to 8, that's a lot. That's a big increase. That's a short squeeze in itself. I would be completely happy just going from $2 to $8 in a matter of moments, right? So that's awesome to me. So that's what I have on Meta. We can check the IR page, the investor relations page, and just see if there's anything else to call out there. This is cool. Okay, didn't see this. And again, I'm not sure how updated this website is, how great it is to say, but Director Allison, she picks up 15,000 shares. You only buy shares in a company, you only acquire shares in a company when you expect it's going up, right? So that's great. You're not going to buy shares of a company right before you report, crappy earnings that will tank your stock price 50%. So I like that idea. $15,000 is not that much. Maybe $28,000 worth of shares. But good for her. Let's see, any other news and events. Let's see if we have anything cool popping. What do you guys think for this week? Do you think the stock market goes higher or lower? Or at least Monday. What do you think Monday's going to do? Okay, so as we look here, just some headlines. Metamaterials first granted U.S. patent for non-invasive glucose. I come over here. I can probably get this. Do we have anything in here? Yeah. So look at here. We've got earnings coming out. This is looking here, and we can see that investor days came out and conferences and the glucose thing, and that's been really shooting the stock price up, right? That's in this very tail end. This is a better chart to see, right? We're near here at this 2.15. We hit over, close over 2.15, close over 2.2. I think off to the races with some decent volume. Okay. Where are we at? Right there. Cool. We can look at the results. Let's see if there's anything good. Total revenue grew again 400%. Let's see. Net loss is only 6 cents per share on the quarter. That's nice. So good to see that they're using CapEx, right? So I think, again, that's a good update on the revenues. I think they're now starting to roll out of the demo revenue, right? The demo products, and they're actually starting to do better, like real sales on things, right? I'm not going to talk about the dividend. I'm not quite as versed about what's happening with the spinoff with Oilco. I don't know how successful it's going to be. It's not quite what I'm looking at here. I just look at the company as a whole, right? Okay. So that's what I've got for Meta. If you think I missed anything, let me know. Even when this goes, we close off the live stream for the night, and this goes public and you can watch it. Feel free to leave down in the comments, right? What do you think I might have missed? So now we're going to look at Alibaba. And I'm not going to break out the balance sheet again. I know that gets a little bit tedious for some people, and that's totally fine. That's why we're here, to walk you guys through it. So I'm actually going to pull up this chart for Alibaba. Again, if you've been on this channel for a amount of time, you know that we really, really like Alibaba, right? The underlying business is growing so much, but the stock price itself is completely selling off. I'm not going to say for any reason, right? For no reason. Obviously, there's a reason, but to me, it's just overly emotional individuals selling it to exogenous events, and I'm going to keep saying that over and over and over again. Because here's the thing: no matter how times I say it, people still aren't going to get it. But if you've been following me for any amount of time, you probably have an IQ greater than room temperature, and that's great, because if you have that and you have the guts and the will, you can make a ton of money in this business. So great job. Cool. So what am I looking at here? Well, this orange line is the share pricing, and then I have this green line, and this is the EPS per share, right? And these are actually denominated in Chinese dollars, the Chinese yuan. I'm not going to switch it over, but you can just get the idea of the business itself. Look here, the business growing. Right here, big spike, but earnings fell down. This is where I want to look at. So I'm going to go zoom in a little bit higher, maybe 5 years. See how the company the stock price just grinded down lower. But where's EPS? It's higher. It's much higher, right? The EPS is nearly, 3 times as high, 3 times as better as it was when it was in 2020, or it's even better from 2017, 2016. So do you guys get the point, right? The company is in much better shape, way much better shape, but it's trading below where it traded when earnings, what we're using for the base effect here. So what does that mean to me? Well, it means that once this thing reverses, it's going to completely overshoot way past its highs. Is it going to happen overnight? No. We've been saying this since this time last year. This is a great company, great stock, great company, and there's been a lot of things to happen, fears of China, but they're all being calmed. They're all being taken care of, right? So what is this? I'm going to look at China HFCA news. Wonder if I can find anything for this. Basically, what's been driving this down though, if I can't find the article, is the fear of delisting, right? So when Trump was in office, he said we have to be competitive with China. We have to tell them who's boss. And I think good though, because they were definitely stealing a lot of our technology of our U.S. based MNCs over there. And he said, listen, if you guys don't comply with our accounting, just the bare minimum, just work with us on the accounting side of the business. Help us understand your books. Help us make sure you're not lying to our shareholders. And just be good business practitioners. Otherwise, if you guys don't fall in line with that stuff, we're going to delist your companies off of the U.S. markets. Are basically going to tap out your access to the U.S. capital markets. And that's not a good thing for a growing economy such as China, okay? So that happened, and everyone's been really worried about China delisting, the war in Ukraine, are they on Ukraine's side? Oh my gosh, who knows? They're not, right? And about 6 weeks ago, one of the ministers, I think the financial minister of China, he came out and he said, we're going to support capital markets. We're going to allow auditors. I think last week the auditors went to China. The U.S. auditors went to China. They checked out the books, or they're checking out the books now. China is rolling back the lockdowns, I would say pretty slowly, but I'd also say sooner rather than later. So all types of stuff there. And then also every 5 years, China has its convention. They have where they elect all of their leaders for the year or for the next 5 years. There's like 3,000 people. And if President Xi doesn't get it together, the oligarchs, which made all their money in Chinese tech, they made all their money in companies like KWeb, in companies that fall into the ETF of KWeb and internet stocks. If they don't fall in line, and Xi doesn't fall in line, and none of the ministers fall in line, then they're just not going to make it, right? Those guys are going to be kicked out of there, and they're going to throw new people in that will support their business and get them more money. And that's just the way the world works. So looking at this here, this is KWeb. This is just the ETF for it. Kind of switching gears, but looking at this on a technical basis. I think we get a pop right in this area, and then it's back up here. It's back up here to the the 90s, the 100, maybe even to the 150s, probably by end of the year. Again, that's just my opinion, but it's kind of contrarian. There seems to be some buying happening though, right? Like it's getting a bid. People are slowly getting into it, and so I think this is a great opportunity to jump into the business, guys. Cool. All right, so that's what I have there on Alibaba. We can look at Twitter. I'm not sure the best place to talk about this, what article or what to look at for Twitter. I would say the deal is, it's 50-50 if the deal happens, but I don't think Elon Musk would be this vocal, this public about it, putting up this much of his money, or at least originally putting up that much of his money, and wasting his precious time on it if he didn't think it was going to happen, right? So there's a lot happening there with Twitter. Chart's not pulling up any news here. Obviously, the media is completely trashing Elon. They don't want him to do it. Maybe because they just, that's just the way the world works, right? If you're taking away the views and you're taking away all of the propaganda that's supposedly happening, they don't want that to happen. And I would argue that we're kind of falling in there, right? The Twitter deal, I would say, is probably happening. Another one that we're looking at is the Spirit Airlines deal, and this is a crazy one, right? Originally, the news comes out that Frontier is going to buy Spirit Airlines. Obviously, the stock price, it just jumps overnight. And we can see that, from here to there, it just jumps, and then it kind of just falls, and then goes again, right? But what's really causing a lot of this drama is that there's another bidder, JetBlue, coming out, and JetBlue wants to up the bid, I think, to $32 away from this $25.50, this $27 bid that Frontier has. As far as we know, Spirit Airlines is saying no. We don't want JetBlue. We don't want JetBlue. But there's going to be a vote, I think, sometime in June, and we're going to see if JetBlue gets the bid. And they get the go-ahead and the shareholders want it, and they can buy it for $32 a share. If that happens, this goes from $19, where we're at right now, to $32. That is insane, guys. That is talk about short squeezes and, we're looking for AMC and the GameStop. Well, there you go, right? Because it's at least going to 25. Good chance. Anything could happen, right? But good chance that it goes to 25. Well, congratulations. You just made how much on your money there, right? You just made a really good return on your money. So we're looking at different ways to play options around it and to use very, very smart ways to sell the implied volatility against the market and make money in a almost no-lose scenario. So if you guys are into that, be sure to check out the Discord and the link as well, because that's a really interesting way that we've been playing it. Same thing with Twitter, right? What else is out right now that's doing? I know there's Chegg. I'm not sure how Chegg. What is this? 500. Can we go back? Maybe they won't. Maybe they don't want us to win tonight. Okay, weird. I'm not quite sure as much on the story of Chegg, but this falls right into our options arbitrage idea that we have, right? This is probably where the news came out for it. So I'm not quite sure what's happening with it in general, but I do want to figure out maybe a good place. If you guys have some info on that, please feel free to share that, okay? Let's see, Facebook. I think Facebook is a buy. I know I had that on the screen on the thumbnail for this live stream. But yeah, I mean, again, do you think that the war in Ukraine is stopping your Aunt Joe from posting pictures on Facebook and liking stuff and consuming content and buying stuff on Marketplace and logging into all of her Facebook apps? Or is it going to stop little Billy from down the street with a VR machine that his dad got him for his birthday? Absolutely not, right? Absolutely not. It's almost immaterial on the business, right? And I'm saying almost because maybe some amount of revenue comes from Russia and or Ukraine. But just think about it in general, like, even if that's true, that it's got such this impact, is it worth, from here to here, this 50% drop or this, 45-30% drop? Absolutely not. No, it's not. So this falls back into our thing of, we want to buy quality businesses at big discounts, a margin of safety, the Warren Buffett way, right? And here's the thing, is that you can even, if you say, hey, I don't want to, hold on to this for 10 years and make money on it, maybe I want to hold on to it for 6 months. You're in the right place, because that's kind of how we focus, right? We tend to go anywhere from 30 to 90 days to maybe even 60 days out, 180 days out, and look at companies and what are the catalysts. So you guys are in the right place, right? So if you're just jumping in, thanks for joining. Be sure to hit the subscribe button. Check out the link for Discord. We have a private and a public group. The private group just has a lot more news and updates and things that I share, my opinion, different ways to play these Facebook, these Twitter, these mergers, and are these arbitrage ideas, right? Again, I think Facebook's at a great place there. Shopify, I just know Shopify is on such a big discount. I don't know the business enough, okay? So bear with me, we're going to look at it. And if you've never seen anyone go through, a company's financials or compare it to other ones, now's a great time to start learning it, right? And I'd love to do this. I'm definitely learning as I do it. I know a ton about this just through, my schooling, my experience, my 5 years of trading. But then also I read a ton of books. I just keep learning, and I'm very passionate. So we're going to look through here. We're going to see, some of the things we want to look at in the tech industry. So we see fiscal quarter. This is just debt to equity. 12% debt to equity. The mean is 79%. So this is a great deal right here for me, right? Return on equity, I'm not looking at this because these numbers are technically wrong because they're not adding back treasury stock from the balance sheet. This is trading at a 10 times PEG ratio. I like a PEG over 1. No one's going to agree with me on that. The whole idea, though, is that if the PEG ratio is growing, it means the PE is growing, and hopefully that's confirmed by earnings growth and not necessarily an earnings decrease, but a price moving up. Hopefully that made sense. It makes sense in my head. Let's see. EPS. Looks like EPS contracted quarterly. Maybe that's what set them off. Operating statistics. Let's see. Net income 3%. I mean, that's pretty bad. Let's see. Twitter. Open text. I don't know what that is. So it looks like either way you look at it, net income is still going to be pretty low. Do we have gross on here? Yeah, 53%. That's great. Okay. 53%, that's a good margin to be at. Workday, so a lot of these tech companies are going to have a higher, gross margin. Which gross margin, guys, that literally just means sales minus cost of goods sold. Okay. So a tech company's going to have a different way of classifying cost of goods sold, but that's the basic idea. Okay. Revenue growth, this is great. 57%, 40%, so probably decent CAGR there. Gross profit 55, 53, 53. Yes, I mean they're growing, right? What's the debt? Well, they've got $1.1 billion, $1.2 billion in debt, but they have $7.2 billion in cash. So I like that idea of the capital structure. If my friend Kyle's on here, he'll definitely know about that. So he's big into capital structure. Let's see. Income. Look at income really quick. Yeah, so they're growing, right? Cost of goods sold. Nothing crazy, right? Unless anything that like this spits out at me. I don't know enough about the business itself, but the whole reason I'm even looking at this in the first place is because I wanted to see, where are we with this over-realized selling? And I think we are quickly hitting the end of the selling, right? Could it go lower? Sure, but again, back to our original, at the very beginning of this, we said the only way that markets could go lower, black swan event, would be from a quick rise in treasury rates, which I just don't see treasuries moving up any higher. Or at least a quick bump up high rate. Okay. So that's pretty much what I've got for now, guys. I don't have much else to say or to talk about. If you have any stock ideas, anything you want me to look at, please let me know in the comments. Feel free to jump on to my new Twitter. All that's going to be in the link in the bio. And then also be sure to check out our free and VIP Discord. That's a great place to get trade alerts, to get a ton of content and a ton of access to me. And I always answer, and I love doing this stuff for you guys. So be sure to leave a like, comment, and definitely subscribe. Definitely helps the algorithm, and I have a fun time doing this, guys. So I will see you back next Sunday. Have a good week.